Mike Martins here, Mike Martins channel. Bear a thought for those living in Australia where they're refusing to raise interest rates. I made a few videos a week, 2 weeks ago, and man, was I dead wrong thinking that Australia will raise rates to help offset against inflation and other economical reasons for exports and keeping, attractive exports, but keeping imports in check and not having to pay through the nose through want-to-be fiat currency. Now, look what's going on here. Australia, 2019-2020 recession, likely rates heading to zero. So, quantitative easing is basically stealing from our futures. I made a video about that too. We're basically borrowing now to steal from our futures, and that's all we're doing right now. We're not letting the reset button get pressed. We're just kicking the can down the road, and we're not moving anywhere. So, excess in the Australian housing market has been widely discussed by, yeah, it's disgusted is what it is. It's disgusting, but discussed by investors and commentators for a number of years. Underpinning by cheap money, house prices have risen significantly, resulting in the extreme valuations of house prices nearly 9 times the average income. It's actually in some parts, that's the average across the board, but in some parts of Sydney and Melbourne, it got to 16, 19 times the average income. Other signs a housing bubble has emerged. Investment in housing is extreme. The percentage of people employed in the construction is close to bubble-like levels, similar to those in Spain and Ireland and ahead of the GFC. Guys, I covered the Spain abandoned cities. Look it up on my channel. The household debt GDP ratio is one of the highest in the world. That's right. So more people are borrowing to consume, and mortgage debt has grown almost twice the period in GDP in the last 10 years, and private investment in dwellings in GDP versus house prices year over year, percentage rates. So guys, what's happening is Australia, Canada, and the UK, a lot of those countries, English-speaking countries, what they did was they pinned their economy on housing and using housing as an economic tool or a strategy to grow their GDP. So here are your recession bars here when you had recessions, but you got to remember the housing market in this is private sector investment in residential housing at levels. So right now, not looking good. And the red represents, what's the red representation? It's not showing. It's all pointing at blue. Ah, here we go. Sorry, guys. Sharp fall in house prices should reduce private sector investment and the cost to drag on GDP. The only way you could qualify now for a mortgage if you're zero debt, I mean you don't even have a car payment. I'm talking like you have no debt, you're ready to put $200,000-300,000 down, and you check through the stress test, looks like it checks out. That's the only way you could get into the market right now, because no one's securing financing with the amount of stress going on for people to borrow. And once you can't secure financing, hasta la vista, baby. With house prices and housing activity now declining sharply, those excesses have begun to unwind, and key lending indicators point to ongoing weaknesses. Building permits, for example, down 19% year over year. In addition, transactions are down 32% year over year. While growth in mortgage lending is contracting and fastest pace in 8 years, both transactions and mortgage lending lead house price growth. So, recession is likely. This is the part I wanted to get to right here. The inverted curves here that we got to go through. Whist is impossible to be certain about a bubble bursting ex ante. I don't even know what the hell they're trying to say there. There is strong evidence that this is the case in Australia. Bubbles tend to burst when money becomes expensive. In that respect, rising pressure on commercial bank funding costs will continue to feed through into the housing sector via higher mortgage rates and should result in further house price weaknesses. With new residential mortgage year-over-year percentage change in variable rate mortgages inverted. So you also have the interest mortgage coming up to fruition. So guys, fruition, I always say it wrong, so who cares? You know what I'm trying to say here. Falling house prices rates, price growth since 2011. And there you go, guys. This is not good. It's not a good sign. Look at that, 2010, eh? It's not looking good. not looking good at all, man. So higher mortgage rates and lower residential loan growth. Well, you're going to have to pay more to borrow, right, guys? As the wealth effect from rising prices reverses, households should continue to deleverage, and their savings rate should start to pick up. No, a lot of mortgages, especially if you're paying down the principal, are a lot of front-loaded mortgages. You'll pay 5 years and you'll have it down 5-6 grand of the total owing. Look at your mortgage and see how much it's gone down in the last 5 years. Nothing. It's all front-loaded. If you recently got a mortgage in the last 5 years, it's pretty much where it's at because they front-load everything and it becomes a huge nightmare to pay down your mortgage. Also, interest-only mortgage 2019, Q1 and Q2 and Q3, you're going to see a lot of mortgages coming up to relist. People, a lot of banks are going to be turning people away and saying, sorry, you haven't paid down any of your principal because it's interest only, and it's time to move on to another lending institution. And what do you do if you can't find one? Well, there is a service helpline that is helping people, Australia Debt Helpline. So, should the result in recession later year on year, house prices growth advanced 6 month versus household savings, 9 months smooth inverted. So that's it right there. This is what they're showing here. This is the house prices contracting, household savings rate increase, and household growth increasing, household savings rate decreasing. So they're looking at people saving more, hopefully to kind of regulate this housing problem. Rates headed to zero. Whilst we never use this word in Canada or anywhere, I've never heard this. A series of RBA rate cuts is therefore likely beginning in the later half of this year. That policy response is probably too late, given the policy works with lags and downward momentum. Housing is already underway. We expect the RBA to cut rates to zero, potentially use other policies in QE. So quantitative easing, guys, they're borrowing from basically our great grandkids now. In the event of systematic banking crisis, not our base case, 20-25% probability, it is also likely that significant government intervention will take place to recapitulate Australian banks. You can't have government involved because it was government that started this problem from the start. 2007, we didn't let the bubble fully explode and deflate. We actually built another bubble on it and lowering interest rates artificially. We haven't done it in human history. The Romans did it. I brought this up before, but the Romans did it with their gold coins. They would add more other metals to their gold coins and basically deflate the price of the gold coins, and got to a point where people just weren't accepting them anymore. And that's what's happening. So here it is, guys. The Australian dollar rebounds as greenback rally fizzles, so you get a little bit of happiness in the markets. It's only because Australian US dollar previously fallen to 6-week lows on Monday, and it's only because the American dollar is not doing as well, and that's why. There it is. You're sitting at a 71-cent dollar right now, as we speak right now, and that's what's happening right now in Australia. We could see a 65% dollar by Q3 of 2019 simply because of the quantitative easing that's going to come in and starting to reverberate through the markets, and basically borrowing from the working poor. And the proof is in our savings account. Back in the day, you used to get 4.5 up to 8% on your savings account. If you had $1 million in your account, you will get basically $80,000 a year at 8%. Now your bank gives you nothing, and that's just proof of how they stole wealth from the medium to middle class, working poor to middle class, how they got basically sold out to bail out the banks, and now how this bubble hasn't popped, was propped by the government with first-time home buyers and all this crap. Now they're reversing it and now raising rates, and no, we're going to reverse it in lower rates now. It's an absolute disastrous nightmare heading for Australia. Canada, the same thing, and the UK, the same thing. The UK has been in decline for the last 20, 30 months now. Guys, don't forget to join me tonight for Trends in the Housing Market, 7 p.m. Wednesday. 7 p.m. Wednesday, LA County time, 7 p.m. Wednesday, Tijuana time. Don't forget to join me, guys. Appreciate your support. Add me on Skype if you want to come on the show. and I'd be more than happy to have you on the show, and we could discuss what is going on in your neck of the woods when it comes to housing. Thanks for hitting me up in the tip jar, guys. Thank you so much for joining me. And Australian, I'll leave the links at the end of this video to show you how I was dead wrong about Australia raising rates, and how it's going to be a perfect storm of destruction in Australia. Thanks for watching, guys.